Hello everyone, welcome back to Chill Deal Trades, where I look at the market so you know what's going on. Today we're going to be covering a fun topic, which is Cathie Wood versus Michael Burry. A lot of news has come out recently, and we're going to kind of dissect what's going on, both Michael Burry's and Cathie Wood's perspective, and then look at the data to figure out, when we peel back the curtain, what's actually going on and if we can figure out what's going to happen in the near term over the next year or so. So if you're here and you haven't hit the sub button, please do. The crew and the squad is growing, so I really appreciate everyone. When we get to 500 subs, we'll be doing a weekly stream together where we kind of dive into the market and analyze stocks, both technically and fundamentally. So please do that. But let's jump into things. So the first thing, I made a video probably about a month or two ago about Michael Burry and his perspective, so go back and watch that. I dive more into Michael Burry's perspective specifically, and I'll put that link in the description, so go watch that one. But the main thing that Michael Burry has been talking about for a while is that we're in like the greatest speculative bubble of all times, and things are going to come crashing down. And that's kind of been his perspective for a while. On the flip side, Cathie Wood kind of fired back yesterday, I believe, and she said most bears believe that inflation will continue to accelerate, but we kind of have the perspective that both the supply chain issues and the burst of inflation are short term, and that we're actually going to see really great growth in a lot of our stocks in the ARK fund, the ARKK fund specifically. And so Michael Burry's Q2 portfolio came out, and so the main update, there's a few of them, but the main one we're going to focus on is the put. So he opened up a put. It's about 1.5% of his portfolio, which if you look at his fund, it's pretty large. So 1.5 doesn't seem big, but it's a pretty big call. And this is a pretty big deal, and this has kind of created a war between him and Cathie. So kind of diving in, Cathie Wood went on like a Twitter rampage, and so we're just going to go through to kind of understand her perspective and what it means, because this can be cryptic if you don't understand how things are connected. So we're going to break that down. So kind of starting here, said, in our view, the seed of innovation explosion is dedicated to research that's been planted during the 20-year end of the technology bust. So back in 2000, basically all this innovation happened for the last 20 years. Things have been ramping up, and we're in like the new age, or the second wave of like the important technology boom. And they believe that this transformation is going to happen over the next 10 years. I agree. I think there's a lot of crazy things that are happening. They do a lot of like stem cell research or gene editing. You have robotics and AI. There's so many things that are blooming and blossoming. But does that mean that they're peaked out, or if they have more room to run? And we'll dive into that later. After that, she said, if we are correct, GDP and revenue growth will diminish until the opportunities in these technologies begin to see move macro needles. In this environment, innovation-based strategies should distinguish themselves. So basically, there's all this fluff out here. All the companies that are public that are kind of trash are going to like die away, and the ones that we hold, the ones that we believe are going to succeed, are going to show themselves, and they're going to be successful in the marketplace. And then after that, she tweeted next, the deflation in commodity prices is cyclical, but is added to the secular forces caused by technology-enabled disruption, innovation, good deflation, and creative destruction, bad deflation. So kind of going to her next tweet. So how you think about it is, when you have this innovative technology, you have resources that it takes to build this technology. And so what she's saying is, actually commodity prices are coming down already, and that shows us that we're headed towards deflation. And deflation is good, you know, accompanied by low interest rates and Fed spending, but lower costs means it's cheaper to make these technologies, and because these technologies are cheaper to make, that means that they can go to the market cheaper and are adopted faster. So that's kind of the timeline of how you think about how these commodity prices affect these new technologies that they're investing in. It says, since mid-May, a number of commodity prices have been breaking down. Lumber down 60-70%, copper down 10-15%, oil down 10%. The unexpected increase in the dollar also is negative for commodity prices. Now in the used car index, which is leading, is showing even a softness in new car sales. And so obviously all these things is kind of saying, you know what, prices are going to come down. And like I just said, it's going to make it cheaper for these technologies to grow and blossom. After that tweet, she came back with a few of them, but this is the next one. The equity market is likely to reward disruptive, innovative strategies once again. And when headline inflation breaks and fears of a recession increased, if the bond market is correct, she's saying because bonds market has been going down, people were perplexed, kind of saying that it was pricing in deflation. So she's saying if the bond market is correct, one or both are obvious during the next 3 to 6 months. She's saying basically this is saying inflation's peaking out, the bond market's telling us this, and this is going to be beneficial for all the stocks that we own. And so the really question is, Cathie believes we're heading to deflation while Burry believes we're headed to hyperinflation. And is Burry or Cathie right about the markets? And that's what we're going to dive into. I accidentally left this in, that didn't mean to be there, but really based on that question, nobody knows what's going to happen. They can predict as much as they want. They can try to use leading indicators, but they can only tell you so much. We really have to wait for the facts to present themselves. And so we're going to dive into the data to try to figure out, okay, with these facts, what are we seeing? So the first thing I want to go into is the CPI and the PPI data. So CPI is Consumer Price Index. And so we can see here that, you know, it's been on a tear basically the last year or so. But this last quarter or last month came in at a slower rate. So after this high acceleration, you can kind of see it there. It's starting to kind of curve off, which means it's still going up, but it's going up at a much slower pace. So that's important to know. But it's also important to know that the percentage change is much different than the CPI change. And August honestly is going to tell us a lot, because just because you have 1 month that's slowing down doesn't mean that the next months are going to slow down. So the CPI number that comes out this month and next month are going to be really important for us to have a better idea. Is it really slowing, or did we just have a slow month because COVID was slowing down, so shipping, you know, was able to increase, or shipping sped up and commodity prices came down for that reason, and that whole kind of mix of things. But it's also important to know is just because the rate of CPI increase is changing doesn't mean CPI is going down. CPI is still at a really high and elevated level than it's ever been, and it's still an issue. And so when we go to PPI, I think it's really important to know is just because we're seeing CPI slow down, which is on the consumer side, so what a consumer spends on something, we're still seeing PPI, which is Producer Price Index, soar higher and higher. And there's been a lot of news coming out about, you know, one of the biggest docks closing in China, which is slowing down. You know, everyone gets their goods from China, so that's increasing costs on the producers. And the question is, what does this mean for CPI and inflation? Because in your mind, what you have to think is, even though we're seeing CPI, the rate of CPI slow down, we're not seeing it for the companies, the people who produce the goods. And so if that's still increasing and it's not slowing down, will those prices just be pushed to the consumer? And will that impact both CPI and inflation? So same thing with CPI. We're going to have to wait for the PPI numbers to come out to see if it's still crazy accelerating. And if it is, then that's showing us that things are still overheating. They're not slowing down. And maybe this excitement for things slowing is people getting a little ahead of themselves. So the next thing I want to talk about is tapering, because that's been a big thing in the news lately and is important for both these arguments from Cathie and from Burry. So a lot of voices have been talking about tapering lately, and we've been seeing a lot of news that it's going to start in September. So if we see this, you know, spending is bigger than it's ever been by the Fed. They're buying crazy amounts of assets. But when we look at I would say the correlation between asset purchasing and the stock market, there's a couple things we want to see. Is when, not that tapering goes down, because it's not going down. Did I put on this slide? Tapering's, when they say they're tapering, it doesn't mean they're stopping, it means they're reducing. So the spending is still going up, it's just going up at a slower rate. And so what we see in the market is, even though in the past, even though they've slowed down buying, if it's still going up, the market typically still goes up. When they absolutely stop it and we see the Fed, purchasing go sideways or down, that's typically when we see the markets respond. So back in 2016, asset purchasing went sideways from the Fed and the stock market had a sideways volatility. Back here in 2018, they actually started reducing their spending, which means it went lower than it was prior. And that's when we saw, COVID also helped with this crash, but it looked like the markets were going to go down anyway. And so that's something important to know, is that tapering will not crash the markets, but it might hurt it. So all these people saying, oh my gosh, tapering is going to crash the market 50%, they don't know what they're talking about, and they're kind of disconnected from what's actually happening and what the facts tell us from the past. The next thing I want to talk about is the federal fund rate, which is basically interest rates. So we know that past crashes only happen when this number moves up significantly. And what the Fed has been saying is they're not even thinking about raising interest rates. So they just started talking about increasing or moving up the tapering day, which is like September, October, November. But they're still saying we're not going to raise interest rates till at least the end of 2022, 2023. And it's not going to be high until 2025 or beyond. And so kind of talking about Cathie Wood's perspective, if we see interest rates stay super low for a long time, that's going to be extremely beneficial for these high-tech companies, because for a high-tech company to succeed, they need to be able to borrow cash at a really cheap rate. And with interest rates barely at zero, these tech companies can pile on cash with no interest basically and continue to produce their products to grow their business, their company growth catches up with their valuation, and then eventually when interest rates are higher, it doesn't matter as much. So that's really important to know with federal fund rate and interest rates. So kind of talking about, asset tapering, there is growing support for it to start in September. So what we see here is there's shifting policy because of all the unexpected higher prices. We're seeing that September could be a day, and I think that's why we're getting a lot of volatility in the market. COVID's resurging, things with, tapering is happening, and people are really unsure what's going to happen. And that's why I think there's going to be a pullback soon, but that's another conversation. And the second thing is there's actually growing support to raise interest rates in September, basically sooner than they expected. So originally they said it was going to be around late 2023. Then a month later, back in July, they said, actually, we're thinking late 2022. And because of because of what they're saying is we're continuing to see runaway prices, and it's difficult to control, and we're seeing a lot of pressures continue to keep prices higher. We're seeing wages are sticky, so those are going to stay around, which is going to be a negative on inflation. And so they're saying we're seeing a lot of data that's telling us that this is a bigger problem than we thought, and maybe not only do we need to taper sooner, but we also need to raise interest rates. And I just mentioned interest rates has a really big negative on emerging technology. And so when we go to Michael Burry perspective, that's going to have a really big positive on his bet against, I would say, the more innovative technology names, very early stage, overvalued, things like that. So I just want to get to my final thoughts. So just to kind of round out everything, Cathie Wood, when you watch any of her videos, she's super long-term thinker. Whenever I watch, these hour-long things she does for her ARK investment, she's thinking 5+ years down the line. And so in my mind, it's like, how much is Cathie really putting a weight on federal spending, low interest rates, and the unknowns about COVID? I think sometimes the ARK Invest thinks past those. Even in her tweet, she said, over the next 10 years, we expect these things to succeed. 10 years is a long time from now. And so maybe they're looking over that. But as I said, in the long term, I think Cathie Wood is is absolutely correct about a lot of these stocks. They're innovative technologies. I think we're close to the second boom of innovative technology happening over the next 10 years. And these stocks are probably going to go up in value and change the world. A lot of Cathie Wood stocks are already down significantly. And so personally, I do believe we're still going to get a 10 to 20% market pullback sometime in the next couple months. But if we do see a rally after that to new all-time highs, I think Cathie Wood stocks could get a little fuel behind them to push higher over, say, the next 5 or 6 months. And the last thing I want to say is we don't know where CPI and PPI are going. We don't know how long COVID's going to last.
and we don't know how important low interest rates and Fed spending is to the market and prices and inflation. And so these are all my thoughts. I'm really curious what you guys think. Please put it in the comments, and like the video if you haven't, join the squad. And I just really appreciate you watching this video.